And then Wednesday was another great example of why it's so much fun working in the mortgage business. So much information, so many changes, and none of them are easy to predict. On the open bonds, we're pretty decent in the overnight session with further improvement that we got after the ADP employment number. ADP employment came in at 127,000 jobs versus 200,000 forecast, which is a pretty big difference. It is one of those things where it sounds really bad that people didn't get jobs, but it's kind of what we need right now in order to stifle inflation. Unfortunately, the last number was 239,000. Hiring at U.S. companies retreated in November at the slowest pace in nearly 2 years as wage gains moderated, suggesting employers may be hitting the brakes amid darkening outlook. Business payrolls rose 127,000, which is the smallest gain since January of 2021. Leisure and hospitality added 224,000, while manufacturing lost 100,000. Median pay change for job stayers was up 7.6%, while the median pay change for job changers was up 15.1%. Job openings edged back by 350,000, so these total job openings to 10.3 million according to the JOLTS report. So all that helped out bonds, and then we got the Q3 GDP prelim, which is the first revision. Came in at 2.9 versus 2.7. So then all of a sudden we get good news. It was 2.6 previously. So we have higher consumer spending, higher inflation adjustment, higher business investment. So basically, long story short, people keep on spending money. If we look at all this stuff together, jobs are shrinking. There aren't as many jobs out there, but we do have wage growth. So we have just enough wage growth to pay for the minimum monthly payment on all the stuff that we still feel like we need to buy, which is why credit card debt is going up. At the end of it all, in the morning, the MBS were off about 20 basis points to start the day. Pending home sales fell 4.6% according to National Association of Realtors. However, there was a positive revision to last month, so that's really only down 3%. Midwest squeaked out a gain, which was about the only region that squeaked out a gain. And upcoming months, we should see return of buyers as mortgage rates appear to be peaking a little bit, hopefully. We're in such a weird place right now, we actually need bad news, which is tough to remember on this stuff. We need people and companies to stop spending money. We need our economy to suffer to a certain extent. We need lower GDP. Like I said, it went up today. Bond market didn't like it. If people won't stop buying stuff, then we need them to lose their jobs so they can't. It's the only way to stop this runaway inflation. Great article this morning by Chris Maloney at Bank of Oklahoma made a good point. It's a good example of this argument. Maybe the FHFA shouldn't have raised their loan limits. Let's think about that for a minute. On one hand, we need higher loan limits because we need affordable housing. We need to have the best financing options available to make homes affordable so people can buy a house. But on the other hand, lowering the conforming loan limit would actually keep people from buying homes, aka buying new stuff. Housing is a big part of the inflation feature. The buying of a home makes rents go up. It makes people spending money. It's good for the economy, which we don't need things good for the economy right now because that increases inflation. And then once they buy a house, they buy a bunch of stuff to go into it, which increases inflation. But buying homes is good for the economy. Yeah, but we need the economy to go down. So which had me thinking early, is it too early to start drinking? And then the Fed came in. Powell had his speech today, where he basically all but guaranteed a 50 basis point hike in December and generally slower pace of hikes. So not a lack of hikes, a slower pace of hikes. The source is important here because Bullard gave us a key clue reminder yesterday about how the Fed works, saying that he would defer to Chair Powell on the pace of rate hikes. In general, Powell's other comments were logically dovish. Based on the data we've seen over the last couple of weeks, the market reaction seems a bit overdone, but it's still occurring inside a narrow range. So essentially what we got from this is the market is accepting that the common consensus of 50 basis points in December and then 25 in the next two is what's going to happen, which will push us up right around 5.25 on the Fed funds rate is kind of the consensus of where it will be and where it'll top out at. So after all of the comments, we ended up getting a giant rally. We had a total of 100 basis points in rally, ending the day up 77 basis points at 101.31, which puts us back above that 100-day moving average and puts us above that pivot point at 100.5. hopefully we can hold in this level, and we can narrow this range between the treasury rate and the MBS rate. So that is a big thing there, is just basically narrowing the rate between there. Also saw this interesting stat, not sure where. New listings are down 20.8% and listing removals are up 56% year over year. So it seems like a lot of people aren't listing their houses right now, and then the ones that are basically throwing it up there for improbable numbers and then taking them down when they don't get it. We also got a post from our sponsor at WellThatMakesSense.com. So this is about nexting. Nexting is a term I hadn't heard of before, so this is very interesting to me. Maybe all of the things we do are an attempt to give ourselves a good enough reason to just be here, existing in the present moment. All about our mind's habit of thinking about, always continuously thinking about what is the next thing, and what to do about it. So check out the post at www.wellthatmakesense.com.